Hello everyone, and welcome back to our channel. Today we're diving deep into a topic that plays a pivotal role in shaping the economic landscapes of nations across the globe: exchange rate fluctuations. Understanding the forces behind these fluctuations is crucial, especially for those engaged in international trade, as exchange rates significantly influence the cost and profitability of cross-border transactions. So grab your notebooks and let's embark on this insightful journey together. What are exchange rates? Before we delve into the complexities, let's establish a clear understanding of what exchange rates are. Exchange rates represent the value of one currency in relation to another. For instance, if you're traveling from the United States to Europe, the exchange rate will determine how many euros you get for your dollars. These rates are not fixed. They fluctuate constantly, influenced by a myriad of factors. The fluctuations in exchange rates can have widespread implications, from altering the profitability of international trade to affecting the cost of living and economic stability in countries around the world. The significance of exchange rate fluctuation. Exchange rate fluctuations are not just numbers on a currency conversion app. They are a reflection of a country's economic health and are influenced by various factors that we'll explore in detail. These fluctuations can lead to significant changes in the costs associated with importing and exporting goods, affecting businesses of all sizes. For instance, a business that imports raw materials may find that a sudden drop in its domestic currency's value increases costs, squeezing profit margins. On the other hand, a stronger currency can make exports more expensive for foreign buyers, potentially reducing demand for products abroad. Key determinants of exchange rate fluctuations. To understand why exchange rates fluctuate, it's essential to analyze the key determinants driving these changes. These determinants can be broadly categorized into four main areas: economic indicators, political stability, market speculation, and interest rates. 1. Economic indicators. Economic indicators provide a snapshot of a country's economic performance and include metrics such as gross domestic product, GDP, growth, unemployment rates, and inflation. These indicators are closely watched by investors, policymakers, and economists as they provide valuable insights into the health of an economy. GDP growth. A strong GDP growth rate is often indicative of a healthy economy, attracting foreign investment, which increases demand for the domestic currency. Conversely, slow or negative GDP growth can lead to a depreciation of the currency as confidence in the economy wanes. Unemployment rates. High unemployment can signal economic distress, leading to a decrease in currency value. A lower unemployment rate, on the other hand, usually strengthens the currency as it reflects a robust economy with higher consumer spending power. Inflation. Inflation is another critical factor. A country with lower inflation rates than its trading partners will see its currency appreciate because lower inflation increases purchasing power. Conversely, high inflation can lead to currency depreciation as it erodes the value of money. 2. Political stability. Political stability is a significant determinant of exchange rate fluctuations. Investors prefer to invest in countries with stable governments and predictable policies. When a country is politically stable, it generally enjoys a stronger currency because the risks associated with investments are perceived to be lower. Political uncertainty. Events such as elections, government changes, or geopolitical tensions can lead to uncertainty, causing fluctuations in exchange rates. For instance, in the run-up to an election, if investors anticipate a change in government that might lead to less favorable economic policies, they may sell off the currency, leading to depreciation. Conflict and governance. Countries with ongoing conflicts or poor governance are likely to experience weaker currencies because of the increased risks associated with instability. On the other hand, countries with strong governance and a stable political environment tend to have stronger currencies. 3. Market speculation. Market speculation plays a vital role in determining exchange rates. Traders and investors buy and sell currencies based on their expectations of future movements, often creating self-fulfilling prophecies. Speculative trading. If traders believe that a currency will appreciate in the future, they will buy it in large quantities, driving up its value. Conversely, if they expect a currency to depreciate, they will sell it off, leading to a decrease in its value. Market sentiment. Market sentiment is influenced by various factors, including economic reports, political events, and even rumors. This sentiment can cause significant short-term fluctuations in exchange rates as traders react to new information. 4. Interest rates. Interest rates, set by a country's central bank, are one of the most influential determinants of exchange rates. They have a direct impact on the flow of capital into and out of a country. Higher interest rates. When a central bank raises interest rates, it often leads to an inflow of foreign capital, as investors seek higher returns on their investments. This increased demand for the currency drives up its value. Lower interest rates. Conversely, when a central bank lowers interest rates, it can lead to capital outflows, as investors seek better returns elsewhere, causing the currency to depreciate. The impact of exchange rate fluctuations on international trade. Now that we've covered the determinants of exchange rate fluctuations, let's discuss how these fluctuations impact international trade. Exchange rate movements can have profound effects on a country's exports and imports, influencing the overall trade balance and economic stability. 1. Export competitiveness. When a country's currency depreciates, its goods and services become cheaper for foreign buyers. This can lead to an increase in exports, as international customers take advantage of the lower prices. For example, if the Japanese yen depreciates against the US dollar, Japanese cars become more affordable for American consumers, potentially boosting sales for Japanese automakers. Price adjustments. Companies involved in exporting may adjust their prices to stay competitive in foreign markets. A weaker currency allows them to lower prices without sacrificing profit margins, making their products more attractive to overseas buyers. Market expansion. Depreciation can also enable companies to expand into new markets by offering competitive pricing. This can lead to increased market share and higher revenues from international operations. 2. Import costs. On the flip side, when a country's currency depreciates, imports become more expensive. This can lead to higher costs for businesses that rely on imported raw materials or finished goods. Cost of production. For companies that import essential components for their products, a weaker currency increases production costs, which can either reduce profit margins or lead to higher prices for consumers. Inflationary pressures. Increased import costs can contribute to inflation as businesses pass on the higher costs to consumers. This can reduce consumer purchasing power and slow down economic growth. 3. Trade balance. Exchange rate fluctuations can also impact a country's trade balance. The difference between the value of exports and imports, surplus and deficit. A depreciating currency can help reduce a trade deficit by making exports cheaper and imports more expensive. Conversely, an appreciating currency can lead to a trade deficit as imports become cheaper and exports more expensive. Long-term effects. Over time, persistent exchange rate movements can lead to structural changes in a country's economy, affecting industries and employment. For instance, a prolonged period of currency appreciation may lead to a decline in manufacturing exports, while a depreciation might boost agricultural exports. 4. Multinational corporations, MNCs. Multinational corporations, MNCs, operating in multiple countries must constantly navigate the challenges posed by exchange rate fluctuations. These companies are particularly sensitive to currency movements, as their financial performance is directly tied to exchange rates. Currency risk management. MNCs often employ hedging strategies to mitigate the risks associated with exchange rate fluctuations. This might include using financial instruments such as futures contracts to lock in exchange rates and protect against unfavorable movements. Strategic pricing. MNCs also need to adjust their pricing strategies to remain competitive in different markets. For example, if the euro appreciates against the dollar, an American company selling in Europe might need to lower its prices in euros to maintain its market share. Profit repatriation. Exchange rates also affect the profitability of repatriating profits. A company earning revenue in a foreign currency may find that a depreciation of that currency against the home currency reduces the value of repatriated profits. Conclusion: the importance of understanding exchange rate dynamics. In summary, exchange rate fluctuations are influenced by a complex interplay of economic indicators, political stability, market speculation, and interest rates. These fluctuations have significant implications for international trade, affecting the competitiveness of exports and imports, the trade balance, and the operations of multinational corporations. For businesses engaged in global trade, understanding these dynamics is not just important, it's essential for making informed decisions, managing risks, and capitalizing on opportunities in the international market. Call to action. If you found this video helpful, please give it a thumbs up, subscribe, and hit the notification bell for more insights into economic trends and international trade. Don't forget to leave a comment, sharing your experiences with how exchange rate fluctuations have impacted your business or investments. We'd love to hear from you. Thanks for watching, and see you next time.